Okay, so let's start here. We're going to go over P14-12. I'm just going to have you turn in Strauss. We're not going to go over it. And then I will start into Chapter 15 because today's Wednesday. Yeah, that'll give us 3.5 days on 15. Yes, ma'am.
So this job, is it go well for me? Is it worth turning in? I mean, I know it's wrong, but I'm sure I got some stuff right.
I would say I would always go for something rather than nothing, huh?
I hope you emailed it to you. You know, the part where she asked if I could call them on, it's not drawing. I'm pretty sure.
All right, we are on page 668. And we've got a company called Burgess Company, and we've got a beginning and ending comparative balance sheet. And note it's in millions of dollars. What it's really saying is each of those numbers has 6 zeros behind it. So when we deal with something like this, and most, you'll see something like this, or you'll see in millions.
Well, no, I understood it was in millions. I just didn't put it in there.
No, you don't. But in your answers, obviously, you have to have, the net change in cash. So you do your statement of cash flow is basically the same thing, name a company. Is it a quarter or a year? I think it's for a year. For year ending. And then you've got to have this so people know.
Oh, okay.
So that's like a required part of the title. So that lets everybody know, that you're not going to write the 6 zeros to everything.
Is it okay if we take it out, like the whole number from all here?
Sure. One or the other, those mandatory. Hi. So we went ahead and penciled in our change column. We scanned the P&L, which, so how much am I trying to balance my statement of cash flows to? Right, my cash went down $30 million, and I want to know why. Which is going to be interesting because I had net income of $115 million, right? So I scan my P&L. What do I pick up immediately from that? I don't think I see depreciation by a scan, do I? I see, my gain on sale of equipment. Then I'm going to go down and look at the additional information. They're helping me with some information as to how to complete my T account for equipment. No new bonds. They paid a cash dividend. No common stock transactions. They had sales of 3,800. Oh wait, what's that next one? Oh, that's the memo, right? Okay, sorry. So let's go back up and do the indirect method preparing a statement of cash flow. So I write out my 3 sections. I plug in my net income. I write. Can somebody tell me the title right under net income? What's the language that I want?
Adjustments to reconcile and income
Takes a village. Adjustments to reconcile net income to net cash flow from operations. Good. That's right after net income in the operating activity section. That's just the little subtitle, and then we put all of our adjustments. So let's just go one by one. So our AR, I'll start back here with Jeff. My AR went up 65, so what does that do? Is a decrease. Yeah, we're not talking in debits and credits here. Okay. So if my AR went, no, yeah, my AR went up, excuse me. So yeah, that's a decrease in my operating section. Okay, Joe, what'd you do with inventory going up of 45? Okay, so if my inventory went up by 45, that's a negative in operations. Let's skip over our property, plant, and equipment and finish off our operating section. So what did you do with the AP going up, Monica? So if my AP went up, what was the other side of that AP entry? If I was crediting AP, I was debiting probably expenses or inventory. But if I'm debiting expenses, what's that doing to my net income? It's dropping it. But did it take cash? No, so you have to add it back. Accrued liabilities went up 25. Jake, what'd you do with that? Good, for same rationale. And Sherry, the income taxes payable went up 6 million. So same thing, same rationale. The other side of that entry was income tax expense. So that dropped my net income, but it didn't take cash. So I have to add it back. So I think then that the cash from operations was 260 million. See, I don't know if I need for the points yet. I might have to grade it myself. Let's see, Strauss. Oh no, here it is. Let's see. Yeah, Burgess. I don't know how many points did I say it was? 15 points. Okay, let me, Gretchen, just let's get through the whole thing, and then I'll do the points just kind of on the fly. Let me just lay this out, because I'm going to probably have to take a look at the memo. Okay, then, so did everybody see that? It was 260. Then in investing and financing, let's go to the first account. Tirsa, what's the first item that I'm looking at on my balance sheet? And what I would do too, you guys, as I go down, I would click off the things on my balance sheet so that I know that I've gotten them in here. So any change ends up in my statement of cash flows. So I've gone all the way through the current asset section. So Tirsa, what happened, or how would you handle the PP&E account? Sorry, can you talk a little louder? Okay, so how did you handle it? I mean, what was your tool you used? Did we not have to set up a T account in this example? Okay, let's do that. I mean, just for giggles, let's do that every time. So what was the beginning and the ending balances? $15.15. Okay, and what did you know about the sale? What did they tell us? That was the cash we got, but do we know what amount to pull out of the PP&E account? In other words, do we have the original cost, or did you have to calculate that? 13. So would you debit or credit that in the account? That increases it. So it looks then like we're plugging this number, correct? What would this be? I mean, not from a dollar, well, yeah, the dollar amount, and what is it? Right? Sales, original cost you pull off as a credit. It's a debit type account. Anything that you bought, you add. And the number there is what? 62. So I think really, so is that the only thing we have to worry about in investing? Well, no, but just for the investing section, is there anything to worry about, else to worry about? Right. Excellent. So in the investing activities section, and again, I don't know how to do this, but I just want to make sure that you understand that it's in two places, right? It's the proceeds from the sale of equipment is the what? What does that mean, proceeds? Yeah, it's the amount you sold it for. It's the cash you got for it, right?
Why is the gain on the sale of equipment negative? Why is that taken away?
Where did that gain on sale of equipment show up, Jess? Which financial statement? Gains and losses are like expenses and revenues. So it's on the P&L. When we scanned the P&L, what did it do to the P&L? Did it raise it or drop it? It raised it. But did I get cash for that gain? This, it is kind of confusing, but this is the cash. That 8 million is the cash. Let's reconstruct this really quickly. When you sell a piece of equipment, what are your debits and what are your credits? What's one debit that you know you're going to have when you sell a piece of equipment? Cash. And what's another debit you know that you're going to have if you've depreciated the equipment? What are you going to pull off your books? Well, I just did that, but so now I'm on my credits. What else am I going to pull off my books? Absolutely, the equipment or whatever it is I'm selling. Whatever I bought it for is what I pull it off for, right? Your plug number here is what? Gain or loss. So in this example, I think I sold it for 8 million. Do we know how much that equipment cost me? 13, right? I had a gain of 5 or 3. So 16.8, 16 minus 8. So I know that my AD had to have been 8 million. So the question here is, how much cash did I get? That's what goes in investing. My gain showed up on my P&L, but I didn't get a check for that, did I? So it increased my net income, but I didn't get cash. This is confusing. This might be another approach if the T account's tough for you to recreate the journal entry. And I can tell you, you're always going to have this. For anything other than land, you're always going to have this. And you've always got to pull it off at the cost. At the original cost. The plug number is the gain or loss. Financing. Who am I having? Melanie, what did you think happened with the bonds payable? I'm sorry, I can't hear you. We did retire bonds because they went down. So when we retire bonds, what does that mean? Yeah, we bought them back, exactly. So did we get cash or did we use cash? We used cash because we went out, you guys all hold my bonds and I buy them back. That's retiring my bonds, exactly. Good job. It's for 170. Was there anything else, Gretchen, that went in the,
The dividend paid,
Okay, did you have to reconstruct? I don't think they told us. Didn't you have to kind of reconstruct it? So what did you do? What did you set up? Okay. So you guys, everyone's going to have to do this. You have to reconstruct these T accounts. So debit or credit balances? Good. So it's beginning and ending. 928. 977. Okay. What are the two things in the real world? There's a lot more things that impact retained earnings, but in our little world here, we're only looking at two kinds of transactions. What are they, Gretchen? That impact this account? This is a portion of stockholders' equity. So what makes this guy go up and what makes this guy? Good. Yep. And then what makes it go down? So probably this is what you want to set up to walk yourself through this. Set up your T account, get in your plus and minus so you don't get confused or rattled about what kind of balance it has. Put in your beginning balance and your ending balance. And then, well, I guess I shouldn't really do that because you can have this or this, right? But set up some sort of model so you can see what the heck do I need to think about, right? So what did you know, Gretchen, that you could put in here? 115. Yeah. So basically then, you don't have a net loss if you've got a net income, right? And you're then going to plug this guy, 66. So the reason we went through all this was they didn't tell us what our dividends were, did they? So great job, 66. That's what I paid. So I used 236. My cash went down 30 million, even though I had net income of 115. And I can tell you on the exam, same as on the extra credit, a lot of, obviously you need to be able to do the numbers, but really then you need to be able to tell me, what does this show me about the company? Jeannie, what's one thing that it shows you about the company? That you couldn't get from the other financials? So what does that tell you about them? Yeah, I'd say they're a growth company. They've got really strong operating cash, much stronger than the P&L number, right? And what are they doing with that? They're investing in new equipment, and they're paying dividends, which is what you want to hear as a shareholder or potential stockholder, right? And then this is pretty significant. How come? This retirement of bonds. Sarah, why is that a big piece of this picture? This would be the equivalent, you guys, of you or I. It's not so much that you're investing in your own company. It's like you or I getting rid of our credit card debt. We don't have interest payments anymore, right? It's like, oh, I'm going to take my income from my W-2 and I'm going to use it to pay off my credit card debt. That's obviously a strong, good thing, right?
Well, and isn't it typically when a company's buying back their stocks and bonds, it's also showing that they're anticipating future growth too.
Okay, help me pull that together. So I'm retiring my bonds, and how does that tie into my growth?
Or maybe more so stocks.
Okay, yeah, I think mostly you want to get out from underneath bonds, just like we want to get out from underneath credit card debt. it weakens your balance sheet. It causes, in personal lives stress, in business lives stress, because you've got to make these interest and principal payments, right? And I'd much rather be investing. This is an interesting point they made that I might have not come up with without spending a little more time on it. It said it's inflated its net cash provided by operations because it deferred payments to its suppliers. In other words, our accounts payable went up by $95 million. So that's interesting. That is indicative of, it's like, yeah, I retired all my debt, but I'm not really paying my current suppliers. So I retired my long-term debt, but I'm pushing out my short-term debt. Mm-hmm. Yeah, that's interesting. I think, I'll go ahead and grade this for 5 points. Let me give you the 10 points for up here, and you can tell me how many you got from the statement of cash flows. Yeah. So let's say that there's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. 11 points for this and 4 points for the paragraph. So 1 point for each line, essentially. And then I'll kind of look at the overall thing for formatting too, and titles, and I may make a point adjustment for formatting and titling. But on the whole, tell me how many points you got out of 11. So if you could write this on the top of your paper, that would be helpful. So put this on the top of your paper, and then I'll fill in that. Yes, because there was 11 lines rather than 10. I'm sorry, Sherry. Yes. Yeah, pass them over to Perry, and he'll make me 2 nice piles. I think I don't know that I've got Strauss's answer electronically or not. I don't know that. Oh no, I must have it because it's typed. Okay. Test. I will open up the solution to what we just went over. Can you hand these out, Jordan? Absolutely. Absolutely. Whatever works for you.
What did she ask?
She asked if it was okay, in the book how they've got those formulas rather than the change column. She said, is it okay if we use those? Sure.
See, that's what I was kind of messing with. Now I'm trying to learn the TV.
Whatever works for you. There's no right or wrong. So let's spend the next, 25 minutes. Jordan just handed out, sorry, this isn't Unit 10, it's Chapter 15. At any rate, she just handed out a set of financial statements. If you could spend a good 3-4 minutes, you might want to get out a highlighter, whatever, and really put your eyes over what you're looking at here. And be prepared to clarify any questions you might have about this actual set of comparative financial statements, because we're going to be working with this to go through all of our financial ratios for Chapter 15. So I want to make sure that you understand the financial statements themselves. Did everybody get this? Okay. Well done. does it look like they do? Where do you see the manufacturing piece? Yeah, they sell some sort of inventory clearly, because how do you see that? Yeah, cost of goods sold, sales returns and allowances, selling expense, right, yeah, it's all over the P&L. Is there anything on the P&L that, on the comparative income statement, that you feel like you need a refresher on, or something that we haven't looked at for a while that should be some?
Are these two separate years, or like the year ending 2011 or 2012?
So these are comparative statements, so they're 12/31/11 and 12/31/12, right?
So other
So they tell us down under the notes on the bottom left-hand column that other expense is interest, and I don't think we really know what the other income is, do we? What usually goes in other income and other expense? Everything that what? Yeah, it says here that this is interest expense, but it's everything that's not in our day-to-day operations, right? Gets thrown down there, like gain on the sale of land or interest expense.
okay, so could the other income be like paying capital?
No, that would be in a receivable account. This would be like, I'm in the business of, selling footwear, and then I rent out my back part of my warehouse, and somebody gives me a rent payment. I'm not in the business of being a landlord, but I get a rent payment, so it goes there. Then we have this weird little thing called comparative schedule of current assets, which those numbers at 550 and 533 tie into what? Yeah, your current assets on your balance sheet, right? What are marketable securities? You guys remember that from accounting too? Yeah, marketable securities are securities that are so liquid that that you've got the ability to sell them or trade them or convert them to cash really easily. So there's a ready market for them, like mutual funds and CDs and things like that. What does it mean when it says accounts receivable net? Net of what? Remember in accounting too, AR minus. Yeah, allowance for bad debts or allowance for uncollectible accounts. I'm not quite sure how you learned it. Gives you net realizable value of your AR. That's what it means here. Inventories, prepaid expenses. They tell us the current market price of the stock is $20.50. What does market price mean? Go ahead. Mm-hmm. Exactly. It's not par value. It's what it's trading for today on the open market. Common shareholder dividends, 80 cents a share. What does that mean, common shareholder dividend? Versus what? Versus a preferred shareholder. Does the board have discretion to declare different dividends for preferred shareholders from year to year? No, why not? Yeah, they're locked in. What's my percentage on my preferred stock? Yeah, 6% of what? Of 100, of the par. 6% of the par value. So each share of stock is locked in, so to speak, if there's cash and retained earnings, to $6 per share per year, right? Absolutely. Absolutely. That's an attribute or characteristic of preferred stock, right, is that you get dividends before common shareholders get their cut. And then really the last thing that it says down here is the tax rate is 30%. Any questions on the comparative balance sheet on the bottom right-hand side? I don't think there should be anything too crazy in there other than it says plant assets net of what? AD, yeah. Okay, so let's just do then, I just wanted you to be able to have kind of a once-over of what was going on, because we're going to use this to go through, we've got, this chapter is dealing with financial statement analysis. So really, basically, you guys have spent this class, well, Accounting 1 and Accounting 2, learning how to prep financial statements. We've spent most of the last 14 weeks in here, other than the statement of cash flows, which is also a financial statement, looking at how to dig into our financial statements to extract management material, right, or management information that we use to make decisions about our business. We've covered, well, you tell me, what have we covered? Yeah, we've looked at things like contribution margin and the Y equals MX plus P, the line, we were looking there at variable versus fixed expenses, right? What else? We were looking at standard costing versus what it actually cost me to produce things and calculating variances. We were looking at how costs flow through WIP and finished goods and direct materials and direct labor. We learned about overhead. We looked at budgeting, right? We looked at flexible budgeting. So those are all ways of managing our business. Financial statement analysis is a integral part of that whole management cycle, and it's the last thing that we're really going to look at in this class. Financial statement analysis is necessary for interpreting and evaluating financial statement data. So really, all these numbers, you need some lens for interpreting and evaluating it, because it's total overkill for your average person to look at all these numbers and make sense of what's happening, right? I will tell you honestly, I sit on a couple boards, and you sit down at a board meeting and they hand out the packets, and there'll be 4 to 5 pages of numbers, of financial statement numbers. I'm the only accountant sitting there, and my eyes immediately glaze over. What do you think's happening to the other 10 people, right? So the first thing I'll always say is, I don't want all your financial statements. I want one page of ratios so you can see what's happening from period to period for the important aspects of analyzing the business. And we have the basic analysis is in 3 different kinds of ratios. They tell us about the liquidity of a company. They tell us about the solvency of a company, and they tell us about the profitability of a company. And every ratio we learn is going to help us assess one of these 3 things about a company. And if I'm sitting on a board, I have fiduciary responsibility, which means I'm responsible to the constituents of the nonprofit. I want to be able to tell them, you know, it could be the YWCA, it could be the United Way, it could be the youth homes, it could be the Poverello. I want to be able to tell somebody, looking at these financial statements, how liquid is the Poverello? What does that mean, how liquid? Precisely. Precisely. How able are they to meet their short-term needs? That's all liquidity is. How able are you to meet your short-term needs? How able are you to pay your bills that are coming due in the next operating cycle? So for you or I, it means, can you make your mortgage or your rent payment next month? Can you, keep your lights turned on? How liquid are you? And a business has the same issue. Profitability is a little bit of a tough word to apply to a nonprofit like the Poverello, but just bear with me here. Although you don't really call it profit in a nonprofit, obviously. What are we looking at when we're looking at profitability ratios? How able are they to what? Generate income. Yeah, generate income. And in a nonprofit, obviously that's revenues minus expenses. In a nonprofit, it's a fundraising, usually a fundraising issue, isn't it? How able are they to raise funds to cover their expenses and have some sort of deficit or surplus? Essentially. And solvency is what? If liquidity is your ability to meet your short-term needs, solvency is your ability to do what? Meet your long-term needs. So they just put up a new building, right? So they've got long-term capital costs. So these are the three sort of categories all these ratios are going to fall in. Who uses financial statement analysis ratios? What kinds of people? Yeah. So short-term creditors, and give me an example of each. What's the difference between a short-term creditor and a long-term creditor?
That'd be like a loan shark in a bank.
An account payable versus like your equipment loan.
Yeah, your short-term creditors are like your suppliers or vendors, your day-to-day operations, people that float you, 20 days of credit for inventory or what have you. Your long-term creditors could be loan sharks or banks, but these are, like your notes payable and your mortgages and your... And I just want to point out, just because I'm a spelling person, there's 2 G's in mortgages. More, you don't hear that first one, do you? Okay, short-term creditors, long-term creditors, what other kinds of folks are going to take part in doing financial statement analysis? Shareholders. Who else? Management team, certainly.
Board members.
Yeah, board of directors, you bet. And lastly, probably your employees. Right? If you're going to work for somebody, do you want to know if they're solvent, profitable, and liquid? So shareholders, management, board of directors, employees, right? So there's a pretty wide swath of people that are going to look at these. What does that say, 1052 on your computers? Pretty wide swath of people. Okay. Before they jump into the actual ratios, they talk about 2 sorts of analysis, horizontal and vertical, which is a type of analysis, but it's not ratio analysis. It's a type of financial statement analysis. Horizontal analysis and vertical analysis. And horizontal analysis refers to percentage increases and decreases between years. Why is it more meaningful for me to tell you the percentage difference in my revenue between 2 years than it is to tell you the actual numbers? Well, yeah, you might have a bad year, sure, but why is the percentage more relevant?
There's an easier concept to grasp than the giant amount of millions of dollars that
Right. What does it mean to you if I'm like, last year I did 55 million and this year I did 55.8 million? Is that good or bad? But you don't know if it's good or bad. The only thing that you can tell me in 2015, let's do a little bit different, 59.8 million. In 2000, interestingly enough, now when you do horizontal analysis, you go back to switching the years in the way that we're used to seeing them. So all I can just tell you is just be vigilant about column headings all the time. It's just funny. In these reports, you do shift them. So what I want you to tell me, in my sales, what's the percentage change between 2014 and 2015? So can you calculate that for me pretty quickly? I don't know, I haven't even found my calculator. No, the percentage change.
Oh, the percentage.
Like, how did you do that? I haven't even found my calculator. $59.8 minus 52, so it went up 7.8 million, and you divide by the base year of 52, 15%. Then, so that was my sales. And my sales RNA were 1.9 million and 1.45 million. Horizontal analysis, what happened to my sales RNA? Went down 23.7%. Don't forget to bracket them when they go down. Why is that meaningful? Like, what would this tell you right here if you just looked at those two numbers for a company? My sales went up 15, my sales RNA went down 23.7.
You're selling more, but less of it's coming back.
Heck yeah. I'm selling more and less of it's being returned, so it's higher quality or it's more desirable, or I'm not having to take things back under warranty. There's less defects.
Do the allowances include a allowance?
No, sales returns and allowances are either customers actually physically bring a product back, which is a return, or they call and say, this is a piece of junk, and I just give them an allowance and credit their account. Okay, so can you do horizontal analysis on anything? Any two items? As long as they're like kind. I mean, if I've got AR net in one year and AR before allowance for doubtful accounts in another year, I'm not comparing apples to apples. So if you've got two apples, you can do horizontal analysis on anything, and it makes things much more meaningful. This is one of the things I always ask the treasurer of boards that I sit on. Rather than spew out all these big numbers, this is what's really important. Doesn't this really paint the picture? What's happening between periods, right? Okay. Vertical analysis is another powerful way. This is used to, see, how can I put this in there? Oh. To common size a financial statement. Meaning, I show multiple, I'll show all items. Show all components So for example, what that says is, so vertical analysis, right, horizontal goes across, vertical goes down, and it common sizes financial statements. It shows all components of any given financial statement as a percentage of a key number. So for example, on Marleya, on the P&L, I'm going to declare all numbers on that, say 2012, let's just go to, as a percentage of what number do you think? What's going to be my key figure? It's like gross profit. I'm going to show that as a percentage of sales. So in vertical analysis, everything is divided by that same, whatever your key figure is. So my gross profit ratio is what? In 2012. What you guys got? Yeah, I got 29.7. What was it in 2011? So, yeah, that's a 0. What does that tell you between the 2 years? Is that concerning to you that the gross profit margin went down a percentage point? Gross profit is what you have to cover everything else, isn't it? So, vertical analysis on a P&L is as a percentage of sales. On the balance sheet, everything is quoted as a percentage of your total assets, which is the same number as liabilities plus equity, right? Okay, I think for Friday, what you should do is, I don't know if reading the whole chapter at one time might be a little much. Why don't we Why don't you read through page 687, and you're going to need to figure out what you're going to use, each of you individually, as a tool to start to get all of these ratios under wraps. There's like, I don't know, 12 or 13 of them. A lot of them are real easy. Some of them are more complex. So are you going to put them on cards? Or are you going to put them on, one sheet?
Are they each like in a section? Like what you said,
Well, the book has it calls it asset management and there's kind of other areas. But yeah, they're basically all in those 3 categories.
so we can like categorize them.
Okay, have a great hump day.